Swayam Prabha. Digital India. Educated India.
Namaskar. In session 32, we will be discussing about international bond market. Here we will be discussing about the euro bond, then you will discuss about different kind of foreign bonds. We will also discuss about the sovereign bonds and bonds, what is the rating of the international bonds. While discussing about bond market, I have mentioned earlier that bond is one of the way to raise capital from international market. Many companies, they issue the capital either through the equity market or borrowing from the international bank through external commercial borrowing, or they raise capital through bond by issuing foreign bonds purchased by either institutional investor or individual investor. Through them, company raise capital from international market. Then while the international bond market is very old, however, bond market as a source of capital very recently developed. The development of bond market depends upon the development of international financial market, the listing requirements, the taxation principle, the ratings and investor appetite to purchase this bond. All these are primary factors upon which the development of bond markets depends. While discussing about the bond market, we will also outline various recently changes rules regulations regarding different kind of bonds issued in different parts of the world. We will confine ourselves discussing about major aspect of bond market, and while discussing the bonds market, we also discuss in Indian context which are the bond issued recently, how much capital different companies have raised through the bond market, and what is the position of bond market at present in Indian context. Let us go to the bond market description side. As I mentioned earlier, bond market is international bond market generally categorized into two different parts. One part is called the foreign bonds, another part is called euro bond. That there is a minute level differences are there between euro bond and foreign bonds. In case of euro bond, a foreign company issue a bond denominated in a currency which is not the home currency of investor. The bond would be known as euro bond. Here the foreign company issuing the bond denominated in foreign currency which is not the home currency of the company investors. The bond would be known as the euro bond. For example, a US company issues a bond, raise capital in Japan denominated in US dollar, this would be a euro bond. Yes, US company, the company US company means he has to raise bond in US dollar, but he is not raising the bond, the company is not raising the bond in US market, rather than raising the bond in Japanese market, but not in Japanese currency, but in US dollar currency. So, it will be known as a euro bond. Similarly, if the company issues a bond in pound sterling in Japan market, it will be a euro, it will be euro sterling bond, because pound sterling bond, pound sterling is a currency raised by the US company in Japanese market. So, it will be euro sterling bond. Similarly, a US company raise bond in US dollar in Japanese market, it will be a euro dollar bond. Similarly, Indian company issue a bond in US market, then it US market, then it will be euro dollar bond, we can call it. So, however, euro bond market and foreign bond euro bond market, though it is the nomenclature wise euro bond, but in general it is a foreign bond market. But in case of foreign bond market, the foreign company issued bond denominated in currency of the issued country is known as foreign bond. An US company issue a bond and raises capital in Japanese market in Japanese yen, it is an example of foreign bond, because here US company, that is company in US, he raised that company raising bond in Japanese market in Japanese currency yen, it is a foreign bond. Similarly, an Indian company raised bond in pound sterling in London market, it will be a foreign bond, because the currency remains the same as a London market currency, particularly the currency of euro or pound sterling, it will be a foreign bond. So, foreign bond and euro bond, the two different kinds of bond, nomenclature wise minute level difference are there, but in actual sense there is no difference. All are denominated in foreign currency and these are foreign bonds. When you discuss about a foreign bond, the issuer is from a foreign country. So, it is a foreign bond. Euro bond market was primarily developed because there was heavy amount of taxes in 1960, early 1960, 70 in US market. So, US companies were not raising bond from US market, rather than they raising bond from other market other than US, and because of tax differences. So, in 1960 and early 70 euro bond market developed, primarily because there was heavy taxation in US, and a company in US market, US dollar denominated currency, they are raising bond from foreign country. Some company also issued what is called global bond. Global bonds means, in a global bond, the issuer offers the bond not in one country, not to a particular sector of the investor, but many countries at the same time. So, in the global bond is also in the form of a foreign bond, maybe in the form of a euro bond, but not confined to one country, rather than spread over to many countries at the same time. Normally, these bonds are denominated in multiple currency also, because it is not confined to one currency, maybe multiple currency, and many companies are issuing multiple currency bond in a global basis, because this bond they wanted to raise different amounts and in different currency. So, they issue the global bond in different part of the country, different part of the world. If you see the bond market further, the bonds are normally issued by a large multinational company, because this company have the liability, they have the asset denominated in different currency. So, they were issuing different kinds of bond in different currency all part of the world, and they wanted to raise capital at lowest possible cost, and the overall cost of capital they want to reduce. At the same time, they want to reduce the currency risks, because if the currencies liability depend are in one currency, liabilities of the company in one currency, it may create some kind of upheaval, some kind of risks. They want to spread the risks having different kind of currency, because their assets also in different currency. So, their liability also in different currency. So, they can be in a position to reduce the mismatches in currency currency wise asset liability and currency wise risks, and because of this reason many translational company or multinational company they were issuing, they have been issuing bond in different currency and different parts of the international market. There are some kinds of bond which is issued by the country which is called sovereign bond. Different country also issued foreign bond, they are known as sovereign bond, but these are not government bond. Government bonds are issued in domestic country, domestic within the country itself, but sovereign bonds are issued by the country for in a currency other than domestic currency in different part of the world to raise money or for international development aspect, they raise money from the different part of the country. These are called foreign bonds. Foreign bonds are different than the government bonds. So, we will be discussing in detail about the sovereign bonds separately. If you see the euro bond and foreign bond, these are different type, different names, different nomenclature available in the market. Foreign foreign bonds are issued in different names. If you there are names which are most confined to the country specific rather than any international aspect of the naming nomenclature, because they are confined to different country, different market segments of international market. So, because of this reason they got their name in different format. If you see there are bonds called Yankee bonds, these foreign bonds sold in US known as Yankee bonds. Similarly, foreign bonds sold in Japan, they are known as samurai bonds. Similarly, foreign bonds sold in UK, bulldog bond. Similarly, if a foreign bonds sold in Spain, matador bonds. The Maples bond, these are foreign bonds sold in Canada. There may be some bonds are sold in Australia, New Zealand side, they are known as kangaroo bonds. So, these are the different kinds of bond issued different part of the international market, and they got their name from the from different country profiles, different country naming aspect. So, these are the bonds most popularly sold, bought and sold in international market. The Yankee bond, samurai bond and kangaroo bonds are more recently developed bonds market, and these are more purchase and buys and trading in the different part of the international market at present, and samurai bonds is very low risk, low cost bond available in international market. Similarly, Yankee bond also US dollar denominated bonds available in US market. So, if you go to the bond type, there are different kinds of bonds also there. So, all these bonds need to be raised, issued and also registered as per the guideline of international market, because bonds are compulsorily rated and these are bonds are generally traded in international market. So, need to be listed in international stock market. If you see the bonds, all foreign bonds have to be registered and have to abide by the rules and regulation of foreign country where these bonds are issued. So, all foreign bonds are also rated by rating agency, and these bond if they issued from Yankee bond issued from US need to be abide by Security Exchange Commission of US. Similarly, the bonds are issued from Australian market, that is called kangaroo bond, need to be registered as per the Australian regulation and practices. So, all these bonds are issued and rated by rating agency, and they are also listed and traded as per the guideline of the respective country where they were issued. If you see among the foreign bonds market, the Yankee bond and samurai bonds market attract the maximum number of issuance. And in early part of 2010, there has been lots of activity in samurai bond market. This because the samurai bond market one of the lowest what is called lowest cost or lowest interest rate coupon rate bonds available in market. So, many companies were issuing the samurai bond to get benefit from this lowest possible cost and lowest possible coupon rate. Among these bonds, the Yankee and samurai bond are most popularly traded, issued and traded in international market. Similarly, euro bonds are not governed by any specific country rules regulation. So, most of the euro bonds are issued in Western European country, Middle East and Asian country, because rules regulation side these bonds are no such little bit what is called relaxed in nature. Because of this reason, many Middle East, Asian country, European country, they generally issued what is called this euro bond, because this bond can be is not confined to, not governed by any country specific rules regulation. This can be issued by many countries, and this most popularly issued from the Eastern European side, Middle East side and Asian countries. Euro bond, you can discuss about more about euro bond. Euro bond may not be rated, because there is no compulsory rating for the euro bond. So, in the issuers of the euro bond, generally reputed companies are issuing the euro bond. So, to attract the investor, because this bond may not be rated and issued by most popular company having high valuation side, high reputation side. So, investor without rating of this bond also purchase, because they know that these companies are good in nature. Similarly, with the relative good rating, euro bonds market has fairly large number of default. If you see the recent default as per the because of this global financial crisis, euro bond market, euro bonds have many euro bonds have been defaulted recently, because these bonds despite being rated, despite being issued by a good company, the companies have not performed well recently because of global crisis, and many such bond early because of recession early 2008, many such euro bond has been defaulted. If you go to further the features of bond, if you see the as we know from the bond market, know from the fixed income security side, the bonds are generally in the form of fixed coupon bond and floating or variable coupon bond. So, then the many international bonds are variable coupon bonds, because it is very difficult, the bonds are long dated security and very difficult to predict the coupon for more than 5, 7 year, 10 years bond. So, variable coupon bond or floating coupon bonds are mostly traded, mostly issued by many company in recent years. What are the difference between fixed coupon bond and variable coupon bond? Fixed coupon bonds, as you know, the coupon or the interest rate remain constant, coupon remain constant till the maturity of the bond. Fixed coupon bonds are normally associated with shorter duration bond, because you know a issuer of a bond cannot, very difficult for its part to fix the coupon for a longer period, because we do not know what will be the interest rate cycle after 4 5 years. So, beyond 5 years bond generally issued on floating coupon basis or variable coupon basis, but fixed coupon bond is generally short duration bond issued by a different company. Fluctuation of interest rate generally do not have effect on fixed coupon bond, and because of this reason they are more attracted by the investor. Such bond primarily the fixed coupon bond normally come with a call or put provision, because call option or put option generally exercised by the issuer of the bond, and they generally provide this kind of clauses in while issuing the bond. In case of floating coupon bonds, the interest rate is pegged to some benchmark rate, because this bond benchmark rate itself is floating and interest rate or the coupon is linked to this benchmark rate. Benchmark rate is a market determined interest rate, and as per the economic scenario, inflation, opportunity cost, recession, development of the economy, the benchmark rate fluctuate. When the benchmark rate fluctuate, the interest or the coupon payment pegged to the benchmark rate also fluctuate, and most popular benchmark rate at, if you see at present, is the LIBOR rate. Depending on the movement of the benchmark rate, the coupon rate varies from period to period, and many such bonds may at present issued at either LIBOR based coupon rate or the LIBOR as a benchmark rate for the coupon payment. To protect the extreme fluctuation within the benchmark rate, there is a fixed and floor. There is a company generally fix what is called a floor limit, a cap limit, because they do not want neither the investor nor the issuer of the bond should be what is called face any kind of problem with the fluctuation of the benchmark rate. Excessive fluctuation, both negative side and positive side, should not affect the issuer of the bond or the investor of the purchaser of the bond, and for this reason generally benchmark rate generally have a floor and cap limit. If the LIBOR increases or decreases, cap rate and floor rate protect the investor, protect the purchaser of the bond, and because of this reason, despite the floating coupon rate or pegged to benchmark rate, and benchmark rate itself fluctuate, there is a excessive fluctuation or either side of the rate generally arrested or controlled by fixing a cap limit, fixing a floor limit for the floating rate coupon payment. And at present many bonds, almost 90% of the bonds are being issued on floating coupon basis rather than fixed coupon basis. And if you go further regarding the features of the bond, there are many kinds of bonds available, what is called zero coupon bond, convertible bond, dual currency bond. These are the associated with the features of the bond. In case of zero coupon bond, as we know that zero coupon means there is no coupon payment on the bond, and the bonds are sold on the basis of what is called a discount rate. A discount, these are called discounted bond. Suppose a bond with $100 with a 10% coupon payment for 5 years will be sold as what is called a $900 because discounted to face value, the discount rate bond will be purchased and principal payment will be $1000. So, in a zero coupon bond, bonds are issued at discount to the face value, and when the investors sell this bond or at maturity, they receive a higher amount. So, zero coupon bonds are discounted to face value, and all discounted bonds are there. There is no coupon payment in between the maturity of the bond. In case of convertibility bond, a convertible bond get converted to company shares or ADR or JDR of the company. So, in case of convertible bond, there is a what is called a minimum time periods of holding, and after the time periods over or maturity periods over, the bond will be converted as per the agreement or as per the market price of the company equity shares or ADR or JDR. So, in convertible bond there may not be any repayment of principal, there may be some arrangement of principal of coupon payment. In case of dual currency bond, in a dual currency bond, as you know, the principals or coupon rate are denominated in more than one currency. The currency may be in the purchase of the principal may be repaid in the form of dollar, bond may be issued in the form of pound sterling. Similarly, coupon may be paid in the form of dollar, bond might have issued in pound sterling. The bond might have issued more than one currency also. Dual currency bonds are available in the market at present. The dual currency bond generally issued to for the swapping of currency or currency swap type of issued generally possible in case of dual currency bond. Company put together different bonds features so as to attract different kind of investor. The company generally either go for a fixed coupon bond or a dual currency bond and convertible bond or a zero coupon bond depend or a floating coupon bond with a mix of floor and cap. All these features the company put together in bond issue so as to attract investor so as for the purchase of the bond. It depends upon the current economic situation, economic scenario, currency market, international market, international financial market. By looking the market, looking at the economic scenario, different companies issue different kind of bond for raising of capital from the international market. If you go further into the bond market, if you will be discussing, you can discuss about that what is called the comparative aspect or characteristic of bond issued. There are different, as I mentioned here, in a bond there are different kind of characteristics are there. The characteristic in the form of maybe regulatory disclosure norm, issuing of rating proposed, maybe what is called the different coupon payment, different way of coupon payment. It may be one currency purchase, different another currency payments will be there, different features are there and different type of risks are there within the different kind of bonds. When you go for analyzing a comparative aspect of characteristic of bond, we should look into the following characteristic, particularly regulatory aspect. Regulatory aspect, you can divide the market between North America, that is particularly US side, and non-US side and Euro bond side. If you see the regulatory aspect, the North America side, particularly the United States side, the restriction or the regulation is stringent in nature. But in case of non-US side, particularly Latin American side, Mexico, the specified agencies are there, specified rating agencies are there, rules regulation not so much stringent. But in case of Euro bond side, the minimum regulatory requirements are there, after that bond can be issued easily. Disclosure norms, in case of North America US side, the disclosure norm is very stringent, SEC guideline is very stringent. But in case of non-US country, the Latin American side, the variable, it is vary from country to country, it is not so stringent. But in case of Euro market, Euro bond market, the market regulation or the disclosure norms is as per the market practices and it is not, it is relaxed in as compared to the North America or US side. But if you show as rating side, the rating cost is quite high, the rating is very stringent and highly necessary or compulsory in case of North America on the US side. It is usually not so much requirements are not there in case of what is called North America, your Latin American country, non-US country. However, in Euro market, Euro bond market, a rating may not required or rating is not required on the basis of the company specific. The companies are good, companies are already rated, there is no requirements of further rating. But issuing cost is issuing of international bond is highly costly and it is nearly 0.75 to 1.25% of the issue size in case of North America and including US. It is up to 4% in non-US country, because the non-US country it is not so specialized, market is not there, so rating cost, the issuing cost is very high. It is generally 2 to 3% in case of Euro market, Euro bond side. And issuance, the speed of issuance when the bond issued, mobilization of capital, which the speed of issuance is moderate in case of US and North America side, it is variable in case of non-US country, Latin American country. In case of it is very fast, bought and sold deal type, very fast, private placements are there in case of Euro bond market. Restriction, if you put restrictive clauses, restrictions are there, quite restrictive in case of restriction, common restrictively quite restrictions are there in case of Latin American country, but it is no restrictions are there in case of North America and US side, and there is no such kind of restrictions are there, restrictive clauses are there in case of Eurobond market. But there are many disadvantages are there. Advantages like in case of North America, US side is a large market, highly liquid market, standardized information available, and these are the advantages for their US and North America side. In case of non-US Latin American countries side, it is a localized market, the feasibility there, local markets and depends upon the market to market differences are there. In case of Eurobond market, the interest rate is low, the bonds are bearer bonds are available, no, there is no withholding taxes, double taxation, withholding taxations are not there. Currency, a diversified currency, you can get currency of pound sterling, euro, you can get the currency of what is called Canadian dollar, you can get the currency of what is called Australian dollar, you can get the currency of what is called South African dollar, you can get the currency of French franc, Japanese yen market. So, Eurobond market is highly diversifiable and currency wise also highly diversified. Then question is, what are the disadvantages are there in different parts of the market? If you see the North American US side, this disadvantage is quite high, disadvantage in the form of highly disclosure norm. The disclosure norm is highly costly, the reporting tax authorities are there, regular reporting will be there, then disclosure norms in the form accounting standards also there. But in case of non-US country, the market is very small, the liquidity is very low liquidity, there is tax culture, tax is different parts. But in case of Euro market, despite being low, information is available, everything is available, withholding taxes are not there, the disadvantages are, but there are many disadvantages are there, particularly the less liquid market. So, if you see the entire North America, that is including US, the non-US country, then Eurobond market, all different part of this markets have different advantages, disadvantages are there, and particularly that the markets are developed in Eurobond market is developed in case of North America and US market, and non-US market is highly segmented, less liquid, high cost, restrictions are there, market is in what is called impure market, and not viable for issuing of bonds. The bonds are being issued in the form of Yankee bond, in the form of an Euro bond market, and both are in the North America US side and also in Euro bond side. So, these are the characteristic of market as compared to direction side, as compared to issuing cost, regulatory disclosure norms, what is called rating side, and liquidity side, taxation side. These are the some kind of what is called I mentioned here, the advantage disadvantages side of different parts of international market. When you go further to the bond market, if you see the recent years, the bond market issued in Indian kind, Indian companies have issued different kinds of bond recently. Indian bond market, though it was quite active after liberalization measure of 1992-93 onwards. However, there are some kinds of bond issued prior to that, and this prior to bond market, prior to liberalization, the bonds were primarily government sovereign bonds in nature, issued by a different kind of public sector undertaking. And after liberalization, many private companies have issued bond. These are the bond like Reliance Industries issued 95 issue year 95 for 10 years bond, $150 million US dollar they have raised with a coupon rate of 8.15 US dollar. Similarly, Reliance company also issued another bond in 97 for the what is called 214 million money they raised from the market. Similarly, ICICI Bank Limited, they issue another one bond in 1997, they raised 150 million bond with a coupon payment of 7.55%. Similarly, Telco company also issued a bond 97, 200 million they raised in dollar term, and the coupon is variable in nature, and the floating coupon linked to the LIBOR plus 200 basis point. Reliance Industry further issued another bond in 97, and these bonds are almost a perpetual bond of 100 years bond, what is called 100 years bond first time they issued, and with a raised capital of 100 million US dollar. Similarly, Tata Electric 97 issue bond 150 million bond with a coupon payment of 7.88% in US dollar term. Similarly, Tata Electric also issued another bond in 97 with a 150 million another bond. They raised money with a coupon payment of 8.50% in dollar term. So, these are the recently bond issued by the different companies in Indian context. But if you see Indian company, Indian bond market, international bond aspect of Indian companies have primarily issued Yankee bonds in denominated in dollar, US dollar. Around 6 companies have issued recently bond, Yankee bond. Reliance company is the first company to issue Yankee bond in 1995. Then Reliance Industry Limited also second Yankee bond 97 they issue. The first they issued a bond of what is called 100 years bond in Yankee, followed by second issue of 240 million US dollar for 30 years bond. Fixed rate Yankee bond issued by with a fixed coupon and maturity period more than 10 years. Floating rate bonds are also issued generally pegged to LIBOR. In India, many Indian companies have issued the floating rate bond, but the benchmark is a LIBOR with a 150-200 basis point more than the LIBOR requirement. So, but do Euro bond market also quite low, many companies have issued Euro issue they have done, and 96 to 9 this company particularly IDBI Bank, ONGC, SBI, IDBI Bank again, ONGC again, they issue Euro bonds most popularly linked to the US dollar market, and they raise bond, they raise money US dollar with variable coupon, fixed coupon depending upon the requirements. So, there are some kinds of bond like IDBI in June 89 they issue 100 million bond. Similarly, ONGC in December 88 they issue 120 million bond. Similarly, SBI also issued in June 1988 150 million yen. Similarly, many other companies have issued Euro bond market and tap the Euro bond market and raise capital. So, but if you go to the beyond that, the Euro issue post 91, that is whatever you post 91, the many companies have issued after the 91 economic liberalization. This allow them to, because the many economic clauses that external commercial borrowing clauses have relaxed after 91 economic reform period. Many companies have issued Euro issue after 1991, like company like Isar Gujarat, Reliance Industry, Jindal Power, then your Sterlite Industry, Bharat Forge, Tisco, ICICI Bank, and then you have Reliance Petrochemical, the Global Telefilms, then then your ICICI Bank also, and also IPCL, they have issued what is called Euro issue after 1991 with variable coupon payment, and also there are maybe some kind of what is called convertible bond also they be issue, convertible in the form of JDR, convertible in the form of ADR, with the mixed features they issue the bond Euro bond in different market of the world. If you see the Indian companies, it is the Euro bond international market even before the liberalization also. The many publishers are undertaking they issue sovereign bond, with a sovereign guarantee in Euro bond market prior to liberalization, and these bonds had a fixed coupon, fixed maturity without having any convertible clause. After 92 economic reform, private companies have issued Euro bonds, and they tap the Euro market to get capital in the form of US dollar, and also bearing few fixed coupon, maximum company, many companies have issued what is called variable coupon with a maturity of more than 10 years. Many such bonds are convertible clauses also there, and these bonds are floating rate bond linked to either LIBOR or any kind of benchmark rate. However, many such bonds also have a convertible clause in the form of domestic share, in the form of JDR, in the form of ADR issued. This indicates that Indian company have appetite to observe the foreign currency borrowing, foreign currency international foreign currency market to raise capital. But when you go beyond this, beyond that, the other company in the world, Indian company issuing of bonds is very limited in nature compared to other country in the world, because many other country the bond issues in international market is very frequent and it is day to day affairs in bond market. However, Indian context is not so frequent and the appetite, though it is there, the cost is very high, the cost in the form of coupon payment, the cost in the form of issuing cost, the cost in the form of get rated from the rating agency, the cost in the form of surrendering the some kind of what is called governance aspect, and cost in the form of regulatory aspect is quite high, and issuing of international bond by a domestic company is it's a rare features, it's a rare not happening every day in Indian financial system. But however, there are redemption pressures also there, because many companies they issue foreign currency borrowing and linked to the convertibility, and they issue the foreign currency bond when the underlying stock were very high price, and when an Indian company when they peg the foreign currency borrowing, foreign currency bond conversion price at a very high price, but when redemption arise, the equity market was not performing well. So, the holder of this bond they did not exercise the convertibility clause, rather than they have gone for redemption as a decided price. So, this lead to redemption pressure on company, and now at present many companies when they issue 10-15 years before convertible bond, now they are facing the redemption pressure, and this has affected their bottom line. And so, while defining the redemption in case of convertible bond, we should be very careful while issuing the convertible bond. Convertible at a high price may lead to redemption pressure, which may affect the bottom line of the company after 10-15 years after the maturity of the bond. So, it will be quite difficult to understand the convertible clause features, and while deciding about the convertible feature, this company should be careful in nature and by issuing a long term bond with the convertible features. Now, but if you see the floating rate notes, there are another kinds of bond available in the market, what is called floating rate notes or debenture issued with a variable coupon pegged to benchmark rate. Many FRN, what is called floating rate notes are have been issued by Indian company in US dollar term and also pegged to LIBOR and US dollar. The like ISAR Steel 94, the 1994 they issued 250 million US dollar, LIBOR plus 2.65%. So, here LIBOR is the benchmark rate and maturity of the bond was in 1999. Arvind Mill 94 they issue 125 million with a what is 12 years bond, 12 years bond they issue. Spike 1996 issue 120 million LIBOR plus 2.5% and maturity was 2003. ICICI Bank issue 2007 500 million US dollar, LIBOR plus 0.54% and maturity was 2010. Similarly, SBI Bank, State Bank of India issue 2007 300 million US dollar with LIBOR plus 0.38% and it was maturity was 2012. These are floating rate notes available in the market in the form of bonds and debenture issued by variable coupon or a benchmark coupon, benchmark plus variable parts, and these companies have been issued this very recently in a foreign market, that is a floating rate notes market. Similarly, if you see there are SBI issue many kind of current currency bond, what is called Indian Millennium Bond, a resurgent Indian bond and also India Development Bond IDB bond, and these bonds were issued by the SBI in three different currency, particularly US dollar and also pound sterling and also pound sterling, US dollar and also Also some of the issue in other variable currency they issued. And if you see the IMD, that is Indian Millennium Bond, it was a bond in the type, currency was US dollar. The SBI raised 101 SBI raised 1.6 billion US dollar, and coupon payment was fixed at 7.75%. The maturity period was 5 years, and maximum part of the bond purchased by NRI community, and forex risks, whatever the risks was there, absorbed by the RBI. And similarly, SBI also issued another bond in 1998, what is called Resurgent Indian Bond. It was a bond, it was issued in pound sterling, in US dollar, also in Deutsche Mark, and SBI mobilized nearly 4.23 billion US dollar, and it was in variable coupon linked to different currency, and the coupon payment was, in case of Deutsche Mark it was 6.25, in case of US dollar it was 7.75, in case of pound sterling it was 8%, maturity was 5 year, and significant part of NRI community they purchased the bond. The forex risk, whatever the risk was there because of foreign exchange, it was absorbed by the central government and the State Bank of India. Similarly, SBI issued another bond in 2000, what is called Millennium Indian Bond, in that is called India Millennium Bond MID, that is what issued in 2000, October 2000. It was not a bond, rather than it is a certificate of deposit, and it was issued in pound sterling, euro and US dollar, and SBI mobilized nearly what is called 5.5 billion US dollar from the market. The coupon was fixed, in case of dollar it was 8.5, in case of pound sterling it was 7.85, in case of euro it was 6.85, and the certificate deposit maturity period was 5 years, and significant part of the NRI community they invested in this bond, and whatever the foreign currency risk was there, it was absorbed by the central government and the SBI. If you go beyond this, the sovereign bonds are available in the market. This sovereign bond generally issued by the country denominated in foreign currency. These are not government bond. Government bonds are issued in domestic currency by the country government, but sovereign bond issued by the country government in foreign currency. All these bonds are guaranteed by the central government. In the country issue, since it is a sovereign bond, default is almost 0, and this bond generally purchased by different financial institutions, governments of other country, and this bond generally used by government for their developmental activity. These bonds are generally rated, may not be rated, and all sovereign bonds at present are not rated. Euromoney undertake a biannual publish own rating of this country. On the basis of sovereign rating, this bond coupon payment, maturity, purchase activity depends upon. Euromoney, if you see, every year they publish what is called the rating of the country, and the rating, on the basis of rating of the country, sovereign bond appetite will be there in the market. If you see the international rating, what is called sovereign rating, there are different kind of parameters are there for sovereign rating. The sovereign rating at present can be divided into 4 or 5 heading. If you what are the factors that govern the Euromoney rating criteria? Euromoney rating criteria primarily depends upon what is called political risks. The political risks have a different parameters. The parameter like government stability, regulatory environment, non-payment of loans, dividend, interest, non-repatriation of capital, then corruption perception in the country. All these take care of the political risks. That is another part of the sovereign rating criteria is called economic performance. Within the economic performance, the banking sector regulations, risks and stability, monetary sector stability, currency stability, current account deficit, unemployment, GNP growth, these are coming under the head of the economic performance. Similarly, we have what is called access to bank finance, that is called capital market access. Then also we have what is called debt to debt, in default or rescheduled debt. These are also parameter like ratio of debt, rescheduled debt, ratio, World Bank and Global Development Finance figure also come over here. debt indicators of the country, like total debt to stock, total debt as a percentage of GNP, debt service to export, current account balance to GNP. So, all these things part of the debt indicators. Generally also have a credit in rating side, normally issued by ICRA or the Fitch rating, Modi, Standard and Poor's. These are the rating agency issue rating of the country. All this rating agency rating also figure in while deciding about sovereign rating. Sovereign rating generally given by the Euro money every year basis, biannually twice in a year, and this year and this they take into account what we discuss about political risks, economic performance, then access to debt market, debt indicators, credit rating side, all these parameters they take into account while deciding about the sovereign rating or sovereign debt crisis. With this, let me close here. The references for you will be the Ferguson and 2006 political risks in international bond market. You can go through this and you will come to know about the history of the bond market in bond market at world level. Similarly, I have given some kind of web page link here, the issue cost in Euro bond market, effect of market integration. Then you can also go through this web page and see different kind of Euro issue and their impact cost. The model question for you, the model question here, what are the main differences between Euro and foreign bonds? You discuss about what are the features of Euro bond, what are the features of foreign bonds. Similarly, second question here, while explain why many Indian companies have faced serious trouble over foreign currency convertible bond in recent years. Here you can discuss here many after the economic liberalization, many companies, Indian companies have issued foreign currency convertible bond. They link the foreign currency convertible bond price to the share market price, which was ruling that time very high, and recently share market price is not performing well. Many issuers, many purchaser of this bond, they want redemption from this rather than converting the bond into ordinary equity share or JDR EDR, and since they are they want the redemption, they want the principal repayment. So, it has become a pressure on the company because they have not developed the sinking fund for the bond repayment, and because of this redemption pressure has created problem for the company, domestic Indian company who have issued 10 years, 7, 8 years, 10 years before foreign currency convertible bond at present. As per your understanding, third question you can discuss, as per your understanding what aspects would be considered for rating of companies bond issuance, how it will be different from rating national government and sovereign rating. Here we discuss what are the factors would be considered for rating of a company, and how it is different from the sovereign rating or national government rating, and what way it differ from them. You can discuss here in case of company rating, the company performance, company board of governor, company management, company balance sheet, company profitability, or company way of doing business, and company performance in the share market, company performance in the bond market, company performance in the product development, company performance in R&D activity, company own strength and weaknesses, everything will be part of the company rating side. While in case of sovereign rating, generally government come over here, government performance of the government debt indicators, government current account convertibility indicator, current account deficit indicator, country performance, all this part of the company, all this part will be the part of the sovereign rating. Sovereign rating, when it is low, it will affect the rating of the individual company within the country. Sovereign rating is high, it may not have any positive impact on the company's rating. However, negative sovereign rating definitely affect a company rating profile. All these things part of your third question answering. Thank you.